Hello Rocky Outcrop Ticians, I'm your friend Rocky Outcrop and I'm back to bring you another Bitcoin technical analysis video for today, Thursday the 27th of February 2020. So let's just roll on with the charts. You can see I've got the Bitcoin chart up behind me, so let's just dive on into them and see what's been going on. Well, thank you very much for joining me for this episode, and if you're new to the channel, then welcome to the family. Thank you so much for joining in today, and like and subscribe because we do this content every day. So let's have a look at where the prices have been over the last wee while, just here on the spot prices, and then we'll take a look at some other things like the CME gap and whether or not it's been filled, and try and figure out where we could be seeing the prices go over the near future. So let's have a look and see. So the prices have come down here, and they almost made it down as far as its 50% retrace line. This is the 50% retrace on the Fibonacci retracement that we've drawn in from the lows down here to the recent high, lows in December there, to the recent highs in Valentine's Day and around that 10,500 level. And we've been using this then since the prices dropped below the 236 to come up with targets for the downside for where we could be seeing the prices go next. And which you'll know if you've subscribed, and if you've just joined us, then like and subscribe and all that jazz. So we broke down past the 236, which makes it a valid Fibonacci, and then you can look towards these next targets here, the 382 at 8943 and the 0.5 at 8460 as being your next two sort of targets that you could aim for in terms of taking profits on shorts at that point, or indeed in terms of looking for a reversal for this to then continue the upward trend, if it were to do so. Now, the 50% point here I think is fairly crucial at the moment, and I'd like to just take a second to then look into that in a little bit more detail by going over to the CME chart. So CME charts, if you're new to the channel, you'll maybe have heard of them being called the Chicago Mercantile Exchange before, but if you're a Rocky Outcrop tician, then you'll know that they're actually the coronal mass ejection charts. And why do we call them the coronal mass ejection charts? Well, because if there's a gap on the chart, and you can see here that there is a gap, for instance, up and around the 16th of February here, and you can see other gaps across the charts, for instance this one back here in the 27th of October last year. When you see that there's a gap in the chart, and it doesn't matter how big or small, indeed you can see there's a tiny little gap just here back on the 6th of January, they tend to be filled. Now, what do I mean by filled? And of course, if you tune into the channel every day, then I apologize for this wee explainer, but I'm just putting this out there for everybody to stay on the same page. And what I mean by filled is that the trading activity will then proceed at some point in the future to then operate in that area where there was a gap before. As you can see over here on the 17th of February, that happened, and it's quite obvious with this big candle how that happened. But if you want a wee bit more of a sort of nuanced example, back here on the 5th, 6th of January, that gap was filled by just this little wick here that came down to fill it. And in terms of wicks just fill in gaps, you can see a really good example of that here in the 24th of October gap was filled here on the 4th of November with a big wick, and it was just wick only that filled it, and it came all the way down to the 200 exponential moving average to do that. Now, before we dive any deeper in here and just check out and see whether our last gap has been filled, I'll just point out really just real quick, just so everybody can stay on the same page again, that back in November the 4th, when that gap was filled on the CME charts, you had a candle here which didn't actually even get anywhere lower than the 200 simple. See, that's where the wick ended, whereas on the CMEs it went all the way down to the 200 exponential moving average, all the way down as far as there. So that's a slightly different, nuanced approach to looking at gaps, where you can bear in mind that they don't necessarily get the same price action happening on spot prices as what would happen on the CMEs if they were to be filled. So it's just a caveat to throw in there. But we do have a gap in around where this 50% retrace would be at, and that's why I brought it up, and that's what I wanted to look at just here real quickly. So if I stretch the chart right out, and I apologize that it's taken most of the price action off the screen, but we're really just looking to see the wick here on today's price, today's candle has come so far, it's so close, but not actually down and into this zone here. Now that's a fairly crucial zone for the price. Has it come down and got close enough in order to filling that gap, or not? And that'll be a bit of a debate that's going on perhaps in the world, trading world right now. And my own perspective on it is that when it comes to close enough is close enough, that if you're talking about a moving average or a horizontal support line or a Fibonacci retracement, all these sorts of things, like close enough is a really good phrase to have and bear in mind, because you don't need to be right up onto the penny, right to the penny, the same price, and to hit the target on the nose every single time. Normally speaking, close enough is close enough, and if you get within a handful of dollars of a move, then you can be satisfied and say that that was it fully satisfied, even though it might not do it precisely to the penny. Whereas with gaps like this one, I would say that that's not quite the case, and that close enough isn't close enough. So I think that we should probably bear this in mind, this zone here, especially since we've come so darn close to it and not actually filled it in yet, as being a potential target for the price to be going to looking forward. So that's kind of the CME side of things wrapped up for now. If this was to be filled, this gap, then there would be no more gaps on the CME chart, and instead what I'd be looking for when I come over to visit this particular chart would be things like whether or not we see a golden cross happen. And the golden cross is when the 50 simple moving average crosses over the 200 simple moving average, and the 200 simple moving average is this white dotted line here, and the 50 simple moving average is this red dotted line here, and you can see that they've not crossed yet on the CME chart. So let's just go back over to the spot prices and take a look at how that looks there. Well, you can see that on the normal spot prices that and spot, by the way, just means just the normal price that you're used to operating with, okay? And the CMEs are not spot prices because they're a futures contract, and that's the distinction there. So just to keep everybody on the same page. So if we go over here to what we're calling the spot prices, then you can see that the 50 simple actually crossed over the 200 simple back here around the 18th of February or so. And since then, what we've seen, in fact, in the prices has been a drawdown in prices, a drop down in prices of currently 17.5% or so, 17%, 17.27%. And that's since this golden cross actually happened. But the golden cross became inevitable, and we knew that it would happen in and around these prices up here, where the actual top of this Fibonacci retracement happens to be the top of the current prices. And since then, we've had a drawdown of more closer to 19%, which is $1,981. This is no small fry thing we're talking about here. This is a big, significant percentage and a significant dollar price action in terms of what's been going on here. So we've had a significant drawdown in price since this actual golden cross happened. Now, what's there to be said about that? Well, these things quite often happen when you have a golden cross. So in terms of the longer macro trend, we can still look towards this potential golden cross being an indicator that in general maybe there's a lot more positivity for the bullish case in the longer term. But in terms of the actual short term, the prices could operate around about here. And as you know, because these are simple moving averages, that the prices could be below the 50 for quite some time, and especially if they're above if they're above the 200 as well here in this sandwiched area, for instance, and the cross would stay crossed for quite some time to come, a couple of months. The prices could even drop down below the 200 here, and they could still the golden cross could still remain in place for quite a while. Again, maybe even a month or two, or at least a number of weeks probably. But for the averages to have actually pulled that down, unless there was, of course, significant action down below, in which case that would pull the averages down quicker, because we're talking about simple averages here. That's the mean, essentially, all of the numbers from all of these candles added together, divided by 50, and 200 periods on the white one, divided by 200 to make a simple average. And so you can see for every candle that gets added on over here, you're still taking off a candle which is way lower in the past than the current ones are anyway, which means that the moving average would continue to rise, because on average the prices have still been higher. So for every candle which opens up going along this way, you still have to go back 50 candles to start seeing an impact downwards on the price. And you can measure that out quite simply. You can see that 50 bars over is all the way over to there. So unless the prices are actually below these candles here, the moving averages would continue to move up the way, and that would probably mean that you could have quite an extended period of downward price action while still having a valid golden cross on the charts. So let's look down to a lower time frame and look for similar crosses. Of course, the golden cross is on the daily time frame, and that's where that particular one lives. But you can see with the 50 simple here and the 200 simple here are looking like they've crossed. They have actually crossed there about maybe 8 hours ago or so, and And since then, the prices have actually had a slightly upward pull on the prices since we had the death cross, which is of course the inverse of the golden cross. It's called the death cross. Nice and dramatic name for that. And the golden cross is also quite a dramatic name in a way, but whatever. And so you can see the prices have actually come up since that's happened, and that's kind of curious in a way. When you see that, especially when you look back and you see that on the 4-hour chart, you do have to go quite a ways back to find them having crossed the other direction. Oh, undo, sorry, just a sec. You have to go quite a ways back to see, because they actually only really crossed back here at the start of January. And then if you go back further, you can see that they only crossed to the downside over here in November. But you can look at the price action and see that even though it's just the 4-hour chart and not the daily, that is a fairly strong indicator of trend. When these crossed to the downside, we had what looks to me to be over a month of downward price action following that cross. And over here, they've just crossed again. So could we see some downward price action over the period of the next month or so, or week or 2 weeks? I actually don't think that the downward price action would last that long necessarily before we'd have other things we'd be looking at other than these crosses and stuff to figure out the trend. This is a good indicator of trend, but we use more information than just that. But could this actually be something which has a downward price impact on the price, or so an indicator of shorter to medium term downward price action, while this on the larger time frame still remains valid as an upward cross? And I think it could, which is why I'm particularly curious to keep my eye out to see whether or not these two actually do cross, because at the point at which these cross on the CME charts, that's what I'm saying here, maybe in around about the same sort of time as that this starts having its positive impact on the market, and we're in the end of this negative bearish cross here, that this death cross in the 4 hours actually comes to its sort of end of its lifespan. So that's what, in terms of the larger trend, and I'm just only looking at one little thing here to try and keep things simple. Of course, like I say, I make these videos every day, and I'm more than happy to include all of my oscillators and all the moving averages and all of the different lines and Fibonacci things that I've got on here as part of our analysis. More than happy to. Let me know in the comments down below if you want me to go in any more depth on anything in the subsequent episode, and I will, okay, or I'll try to at least. So but really just wanted to focus on those things alone. If we look down at the oscillators down below, just for the sake of completeness on this episode, we can see that there is that on the 4-hour chart, we said that if the prices were to have turned around at any of these points here compared to the lows previously, that you would have had hidden bullish divergence, because this is overall has been in an uptrend, and those prices turning around up at these higher price points around 9,200, for example, would have meant that even though we've made some lows, that in the bigger picture we were still making higher lows and higher highs potentially, and in an upward trend, in which case you would have been able to identify this as hidden bullish divergence. But that hasn't played out, and that's of course what you would expect, because it was anticipating, it was being predictive, saying that would be hidden bullish divergence, and when it hadn't been set in stone yet. And in fact, until such times as it's set in stone and the prices keep on dropping, it's just bearish convergence, which is actually negative pressure on the prices. So it's an increased momentum to the downward side alongside an increased momentum downwards in the actual price action itself. So those things converging together means that the market is responding in accordance to the wills of the people who are trading as part of it, as opposed to when there's a divergence there, you could say, well, the price action isn't actually necessarily operating in lockstep with with what we might think is the motivation or the momentum behind the market at that time, in which case you'd identify a divergence and look for potential reversals against the current trend, or against the prevalent trend at that time. So we don't have any of that currently. And in terms of the ups, because I'm looking at the top side in a downtrend, which we can do just here, you can see these there isn't actually any hidden bearish divergence really, but there is class of sort of class A variety, but there is class B variety, where you can see here that these two tops in RSI are the same height, but the price action didn't actually go as high between these two tops here, which means there's hidden bearish divergence, and hidden bearish divergence reflects continuation. So while it's divergent, the divergence here is between the price action and the oscillators. In terms of looking at the motivations behind the market, it's not divergent to the trend of the price action, because the momentum here was as strong as it was before, and there was as much impetus and will amongst the buyers when you look at the stochastics and the RSI. The MACD is slightly lower, so this doesn't quite count for the MACD down here. But certainly on the RSI, when you look at that and you think, okay, so the market is trying as hard as it can to push the prices up, as hard as they could over here, yet the prices are not going up as much. Therefore, there's hidden bearish divergence, which would signal a continuation to the downside, because despite the efforts of the market, the prices are actually didn't actually reflect those efforts, and so the best will of the world could only get you up that high, which means that with all that effort still on board, the prices would likely drop. So that's how that there works, and we can see then on the 4 hours that there's that, and that's not so particularly good for right now in terms of whether this would turn around, because when you look at the RSI and you think, well, it's come down here and it's been rejected off of the bottom of the bearish control zone, and it's making its way up, and it's just crossed over the moving average here that I have on top of the RSI. Maybe that indicates good, and that does indicate good things, but we're also looking at a death cross here on the 4 hour, and we're thinking, well, we've got this hidden bearish divergence, and could we come back down here and test this again, at which point we could maybe fill that CME gap. So that's kind of building out that picture about what the current prices are looking at here from a slightly broader perspective. And you can see that as well with the stochastics that we came down here below to this oversold zone, and then we come back up slightly here into what would be considered the edge of the bearish side of the stochastics, on this downward part here, where you're not actually in the oversold zone yet. We're coming back in here. We're sort of 1 foot in, 1 foot out. And could we see us come up here and maybe turn around and test the bottom of this zone again, or maybe be perhaps rejected off of re-entering back into here on our first try? We could, so these are little things to sort of bear in mind, that despite the fact that we've got a more rosy picture here over the last, most of this day, really, to be honest with you, where currently we can see the prices at 8,858 are close enough are not close enough, but are on the upper end of the day's price action up here towards the 8,900 level where we've had our tops. So what do we have up above us in terms of resistance then, horizontally looking at the charts? Well, we have this green line here, and what is that green line? And we can zoom out and we can see that it is the 382 of this Fibonacci retracement. So we came down below the 236, came right down towards this 50% up here, and now we're being sort of rejected or resisted by this line going across here. So that's our current area. So if we do want to see these things kind of become less important, if we do want to be able to take a sort of to start to think maybe we were close enough on the CME charts and all that sort of thing, then what you need to see is the prices coming up above 8,950. That's the very first step there on that basis. So if you were to be, say, looking to, and I'm not a financial advisor, none of this financial advice, but if you were to be, say, looking for longs, or indeed if you're shorting or anything, in and around that price is a much easier area to manage your risk than it is from where we are just now, for instance. So you can see, if you had have seen that earlier on, if I'd made this video 5 hours ago, I'd have been saying the same thing. Then you could have got in on that wick and taken it down here for a $100 move, which, is not to be sniffed at. However, if you were also going long there, then you could possibly have thought to yourself, right, well, I'll only go long if the prices go up above this area, and if they drop back down below, then I'll stop out just for a couple of dollars loss there, for instance. Now, this isn't financial advice. That's not even how I particularly trade myself either, as it happens. But that's one way of doing things, and I just wanted to sort of point that out to you, rather than to have you thinking, well, okay, so Rocky, where are the prices going now? What do you want me to do? Should I enter? Should I go long? Should I go short? And, well, I mean, you could do either. It's just that if you were to do it from where we are right this second, it wouldn't be offering you up as much value in terms of your risk management than if you were to do it up there, and that's really what we're looking at. And likewise, in terms of longing it, if you were really wanting to long it and get the best value from it, then the safest and best area to do that from would be, in terms of the current price action, would be down at this 50% level. And failing that, of course, then where we're looking down to afterwards is possibly down to 8,000, 7,900 or so, where the prices could easily retrace to. And I'll just finish off then. This video's been 20 minutes. It's far too long. I spoke spoke slowly. I tried to cover a few things and it's dragged on for too long. I wanted it to be 5 minutes. Can you believe that? 4 times longer than I wanted it to be. So I apologize about that. But if I put these other Fibonacci retracements back on that we had before, so I've got 3 Fibonacci retracements on the chart at once. So excuse me for the noise. I'll go up to the weekly so that we can see them all a bit better, and you can see up here that it's that one's drawn in from the all-time high down to the bear market cycle in 2018, and then the next one along was from the highs in June 2019 down to the end of this the bearish cycle here in December 2019, and then of course the one that we were talking about throughout most of this episode is it started down here in December 2019 and up to the highs in Valentine's Day or so, and we can then go on into the prices and look and see that there is there are more areas to the downside where we can aim for targets and be satisfied when the price goes around that area, that perhaps that's where it would be more likely to turn around. For instance, in around the low 8,000s and that 8,200 number, where you have the 236 retracement here from the June Fibonacci level, you can see that, for instance, that would offer up a potential area for us to turn around the price. And of course, down from that, you've got the 55 moving average just in there, so that's another thing to be aware of. You've also got the this general area of support, which was previously resistance and whatnot as well in this area. And then following on from that, you've got the 618, which would be the greedy point to aim for on a retracement down from this retracement here from December to Valentine's Day. And my final point would be then that if it did go past the 618 and all of those other areas, and of course you'd be going past the 236 there, that you could be in line to then try the 236 from the overall bigger Fibonacci retracement, which is all the way down at 7,000. And that would be obviously there's other areas in between that you could look out for instance the 786 of this Fibonacci retracement, but just to be aware from a risk management point of view that's where it could potentially end up going. And of course that the inverse of that applies if you're shorting it, and that's what you're looking for. So thank you so much for tuning in. 22-minute video. I apologize about the length. I'll publish this one nevertheless, and let me know in the comments down below if you'd have preferred it to have been 10 minutes shorter, if you think that I could have said things a bit quicker, maybe I waffled too much, just whatever. Let me know what you think. Thank you so much for tuning in. I really appreciate everybody who likes and subscribes, by the way. Absolutely, I'm over the moon about being over 100 subscribers. Can't quite get over it still, so thank you so much, and let's see how high we can take this, and welcome to the family.